Good morning from London. I'm Anna Edwards alongside Tom McKenzie. We're an hour away from the opening trade. Here's what you need to know. American and Chinese negotiators agree a framework to ease trade tensions after 20 hours of negotiations in London. The deal still needs to be signed off by Presidents Trump and Xi. Futures in Europe and on Wall Street tick lower as attention now turns to today's US inflation reading. Plus, the UK Chancellor sets out her spending priorities. Rachel Reeves will defend her fiscal choices in the face of a weakening labour market and declining political fortunes.
OK, so we watch the FTSE 100, of course, and see how that story evolves in the equity markets on the back of what Rachel Reeves has to say. You saw US markets closing up around 5 to 0.6% by the end of the close on Tuesday. European futures ended flat. Today, the picture is a little softer. As you mentioned, down 0.3% in terms of European futures. S&P futures stateside down 0.3%, looking for, it seems, the next catalyst. Will it be inflation data? There wasn't a lot of detail out of those US-China conversations. The benchmark 10-year in focus as we lead up to the inflation print out of the US at 4.47 euro dollar, currently largely unchanged at 1.14. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. Welcome to the opening trade. It's just gone 7 o'clock here in London, 8 o'clock if you're in Paris or Berlin. You are very welcome. Tom joins me today, and we need to start, Tom, our conversation around China-US trade conversations. They talked late into the night here in London. It was the second day of this London summit at Lancaster House. And there are different ways to spin this. You can either say that the mood music was very positive, the tone, the de-escalation. Yes, it's subject to President's approval, but achievements have been made here, a little bit of cementing of what we already heard about in Geneva. Or you can say that there wasn't really very much new here. It was about rare earths and magnets on the one hand and trade in chips on the other. But there wasn't new ground covered, and the clock ticks to the end of the 90-day reduced tariff rate between the two.
It absolutely does. And we know that Beijing wants to see those tariffs removed, which seems, at least in their entirety, pretty unlikely if you listen in to what Trump officials and the administration has been saying in recent weeks. But to your point, in some respects, this could be just looking at a reset of the Geneva conversations, because it seems that what they didn't have on the back of those talks in Switzerland was a framework for implementing the deal that they came to. Now it seems they have that framework around implementation. That's what led, it seems, to the disagreements between both sides and the ratcheting up of tensions prior to the talks in London. It goes to the presidents. We'll see if they sign off on it. But yes, you could filter this down to a conversation more about chips and rare earths, and the reminder that Beijing now realises it has significant leverage when it comes to those rare earth export controls. And though it might ease them, it's not going to be scrapping them.
Yeah, and that seems to be what is being picked up in some of our reporting today, the leverage that China has played with here, because it seems as if, magnets and rare earths crucial to various manufacturing sectors and consumer-facing sectors in the United States. They get on the phone to the White House, complain they don't have access, and then President Trump asks for a call with Xi. The two presidents talk, progress is made, but that does just, as you say, illustrate the leverage perhaps that China has on that particular subject, and the use that the United States made of countermeasures, I suppose, with regards to chip exports. But what should our expectations look like from here then, as we're a third of the way through the 90 days, and still we don't have clarity on where that's going to go, and we don't have any meetings in the calendar, nothing in the diary in terms of the US and China meeting once again. Evercore talking about how actually any deal between the two might just be quite modest. It might be about agreeing to export various things to each other, trying to reset some at the margin of the trade relationship that way, and maybe a deal on TikTok, but not thinking that we're going to get a real substantial reset of the trade narrative.
A grand deal, a grand reset between these two trading partners, the world's largest economies, of course, number one and two, seems a long way away at this point, doesn't it? To your point. On the tariff story, we've already seen the impact in terms of the export drop to the US market from China, falling about 30%. And that ties us to the inflation story, doesn't it? Fewer goods obviously being shipped from China, even with those tariff rates being almost sliced in half, still at a relatively substantial level. And we're seeing that drop in export levels and what that means to the inflation story of the US.
Yeah, absolutely. So we are expecting that there'll be a bit of that pass-through effect of tariffs into the CPI print today. So, not fireworks perhaps, but we're expecting a tick up in CPI, up to 2.4% on the year-on-year number. If you prefer it the month-on-month, then that's up to 0.3%, excluding food and energy. So a little bit of a tick up there. But crucially, we're expecting some pass-through. The longer these tariffs stay in place, the harder it is for businesses to absorb them on the margin, the more they need to pass them through to consumers. But we have, of course, seen a number of these tariffs either suspended or substantially reduced in the short term. So it's not as if we're in sort of max tariff scenario, or are we, depending on how these negotiations go. So we might be looking for that small tick up. But on the other side of things, there'll be certain factors to do with services that might weigh downwards on CPI. And
energy costs softer as well, so that may be a benefit. But as you say, on the core level, 2.9% seems to be the number that the estimate, at least, that could come through on the back of this inflation data. Aberdeen speaking to us earlier, their economist and their head of economic research, saying as a result of the stickiness around inflation, they don't see more than one cut from the Federal Reserve this year. A combination of the fact that the labour market is still holding up, this is their assessment, relatively well, and that inflation is looking a little stickier on the back of the tariff input. They expect just one cut from Federal Reserve that, of course, has talked about needing to get that optionality, being on hold at least for now, needing to see how this story evolves.
Yes, and that fits with the chart we're showing on the screen right there. The fact that the market is paring back its expectations of rate cuts fits with the jobs report of last Friday. Of course, there was a downtick in jobs created, but it was better than the market had been anticipating. And so the market continues, at the margin at least, just to price out some of those cuts. And now we see pricing in around one, as you point out. Tom, should we move to the UK? Because we're waiting for UK CPI data. We're also waiting for the UK spending review. And this, the sort of the headline act, I suppose, for a Labour administration that's been in post for nearly a year now, but now still needs to come forward with its spending priorities. How does it reshape £600 billion worth of annual government spending in its own image, in the way that it wants to? How does it make its mark on the UK economy? And can it tackle some of the headwinds that it faces, and some of those of its own making, perhaps? So, for example, the labour market is floundering a little bit. We've seen the weakest labour market in 5 years, by some measures, in terms of the number of jobs in the market. So that's going to be something that the government is going to want to push back on, that kind of narrative. Can they reset things, talking about infrastructure, talking about spending on defence, of course, and those domestic priorities around the NHS, and spending on police could get political.
Yeah, and talking of politics, of course, the polls have suggested and shown that the public frustration with the delivery of this government is front and centre, and the poll ratings have fallen for this Labour government, for the Prime Minister, for the Chancellor as well. Our reporter James Woolcock earlier on the show saying that this is a moment that actually charts the political course of this government over the next 3 years. So that's the political significance. The economic impacts are clearly there. I wonder to what extent we look ahead already to the autumn budget and a question around potential increases in taxes. The Institute of Fiscal Studies, they have come out, their head of economics, and said that you could be looking at pretty chunky additional tax hikes as the Chancellor is squeezed around her spending rules. Either cuts or tax hikes to make up for that shortfall. That's in the autumn budget. That will be on the minds, you would have thought, of investors today.
Yeah, absolutely, and that's certainly going to be one of the conversations that we pick up on later on today, later on in this programme, around the UK spending priorities. Let's tell you what else is coming up on the programme. Guy Miller, Zurich Insurance Company Chief Market Strategist, will be with us. We'll talk about the markets, how they are responding, a little bit of downward response, perhaps in terms of risk sentiment to that China-US trade narrative. Not huge, but US futures down around 0.4%. Karen Ward, JP Morgan Asset Management Chief Market Strategist for EMEA, will also be with us. We'll get her perspective as we move toward the second half of 2025. Meg Hillier, as I was referencing, this will be part of our conversation, the UK spending plans, UK MP for the Labour Party, and crucially chair of the Treasury Select Committee, and it's in that latter role that she'll be looking to hold the government to account, and certainly the Treasury, that department, that Select Committee looks to hold the Treasury to account in its spending decisions, so we'll get into that a little bit later on in the programme.
OK, here's what else to think about today then. 12:30 p.m. UK time. We do get the UK spending review. We will be giving you comprehensive coverage, of course, and analysis of that key announcement and the details from the UK Chancellor. At 1:30 p.m. UK time, the focus will switch at least momentarily to the US inflation story, with inflation data, CPI data, as we've been talking about, dropping at 1:30 p.m. UK time. On a core basis, you could see a tick up to 2.9% for the month of May, year on year. And then later in the day, 6 p.m. UK time, we're going to get a 10-year Treasury auction, so a focus on how much demand there is as you continue to see some angst, of course, about the debt load of the US on this spending plan that's working its way through the Senate. And at 7 p.m. UK time, the US federal budget balance. Those details will drop at 7 p.m. UK time, Anna.
OK, here's what else you need to know this morning. 700 Marines deployed by President Trump have arrived in Los Angeles as protests over immigration raids stretched into a fifth night. The city imposed a nighttime curfew with more than 380 people arrested since the weekend. California's Governor Gavin Newsom accused Trump of misusing his power and warned the rest of the country to prepare for similar unrest.
California may be first, but it clearly will not end here. Other states are next. Democracy is next. Democracy is under assault before our eyes. This moment we have feared has arrived.
Trump says troops would remain in Los Angeles until, quote, there's no danger, and the city would be burning had he not sent troops.
If we didn't get involved, right now, Los Angeles would be burning, just like it was burning a number of months ago with all the houses that were lost. Los Angeles right now would be on fire, and we have it in great shape. We're not playing around.
The US has sharply criticised 5 allies after they imposed sanctions on 2 far-right Israeli government ministers for inciting violence against Palestinians. The penalties on the ministers were imposed by the UK, Australia, Canada, New Zealand and Norway. They said both men had, quote, incited extremist violence and serious abuses of Palestinian human rights. But the US Secretary of State Marco Rubio urged the reversal of the sanctions, saying it stands shoulder to shoulder with Israel. NATO allies are considering allowing contributions to Ukraine's defence in the new spending target to be adopted at a leaders' summit later this month. Sources say Secretary-General Mark Rutte is seeking to keep the US fully engaged by getting member states to allocate at least 5% of GDP for defence spending. Trump has said he'll attend the summit in the Netherlands.
Coming up, the world's largest listed clothing retailer meets profit estimates. We're going to see how Inditex shareholders react to the company's stable outlook at the open. Plus, we are going to preview the UK Chancellor's crucial spending announcements later today with the chair of the Treasury Select Committee. Up next, it's been a marathon of negotiations over the past 2 days, but the US and China have reached a framework for a deal. Will the president sign off on them? We discuss. If you have any questions of your own for our guests, do send them to us on IB plus BBTV Go. This is Bloomberg.
This is the opening trade, Wednesday, the 11th of June, everybody. This is the picture on European equity market futures then. A little bit of a retreat in prospect, it would seem. DAX futures in particular expected to be a little bit weaker at the start of trade. Not a huge amount of corporate reporting then today, Tom, but we do have, of course, the sentiment coming from the US-China talks, lacking details, still needing presidential sign-off. As a result, European futures and US futures both a little weaker.
Yeah, still looking for detail, and maybe we'll get some now from Lizzie Burden, who, of course, has been covering this for us over the last few days, standing outside Lancaster House, at least up until yesterday. The US and China agreeing then to a preliminary plan to ease those trade tensions, which now goes for approval to the nation's leaders. The presidents have to sign off. Of course, American negotiators say they expect issues concerning rare earths and magnets will be resolved.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way.
In the past 2 days, China and the US teams had in-depth exchanges. Our communication is very professional, rational, in-depth and candid. Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th and the consensus they reached in Geneva.
Well, for more on this, I'm joined by Bloomberg's Lizzie Burden, who I said has been covering this for us over the last couple of days. Lizzie, is that as much detail as we get then? Lutnick talking about the magnets on one hand and the restrictions on things like aircraft engines, I should say, into the Chinese market? Or do we get more detail in terms of how these discussions came about and ended ultimately.
It looks like it, Tom. There is a framework, but we've yet to see it. We had 20 hours of negotiations in total. The US Treasury Secretary Scott Bessent having to leave early. He had to get back to Washington because he needs to testify before Congress. So you had the US Commerce Secretary Howard Lutnick and the US Trade Representative Jamieson Greer back round the table to thrash it out. They emerged just after midnight with a plan, a preliminary plan, which, as you say, now needs to get the seal of approval from the two leaders, President Xi and President Trump as well. What's in the crux of that deal is that essentially China is going to send more rare earths to the US. They'll resolve that issue, they say, and in exchange the US will roll back some of those export controls that were introduced in retaliation since the Geneva Agreement. But when it comes down to it, the question is this going to lead to another explosion in the relationship? What happens if that's the case? And crucially, they haven't got any more meetings in the diary. That's what Jamieson Greer says. So it looks like, yes, we're not going to see a decoupling for now, but we're not out of the woods yet.
Right, yes, things didn't kind of spectacularly collapse, so that's an upside, Lizzie. But on the other hand, we don't have a huge sense of how things progress to the start of August when the 90-day deadline comes to an end. So in terms of what we have heard, who came out of this best?
Well, if you look at the market reaction, Anna, and there wasn't much of one, you saw the yuan inching a little higher and US equity futures a bit to the downside. So perhaps you could say that the market has deemed China the victor here. But I would say the important point to take away from these talks in London and the past few weeks since the Geneva Agreement is just the importance of export controls as a weapon in modern trade warfare. And it's been well demonstrated by Beijing. Tariff may be Donald Trump's favourite word, but it isn't the only tool to use in a trade war. Yes, you've had a court ruling that Trump can proceed with his tariffs, but look, this isn't over yet. The US is trying to rustle up deals with other trade partners like Japan and South Korea, India as well, and a host of other countries. But China can get on the phone too. And indeed, President Xi's been speaking to the newly elected president of South Korea. So not over yet. But in the meantime, as you say, we look ahead to a grand deal between the US and China. But if you look back to the first Trump administration, phase one took an 18-month period of negotiations. So it looks like we're in it for the long haul.
Lizzie, thank you very much. Lizzie Burden there with the latest on that trade conversation between the US and China. And in terms of winners, certainly some of the Chinese rare earth companies have been doing very well through today's session. Let's broaden the lens, though, and talk to Guy Miller, Chief Market Strategist at Zurich. Guy, nice to speak to you this morning. So are you comforted by the tone, by the collaboration that's still in evidence, or the conversation at least that's in evidence, the de-escalation, or are you concerned that we go towards August, early August, we could end up in a situation where we have higher than 100% tariffs once again? We don't have an off-ramp for that yet.
Well, a preliminary agreement to a framework doesn't fill me with enthusiasm in terms that this is all going to be resolved, and I don't think it will. One forgets that in this period, it seems, of calm and the way the markets are responding, tariffs in the US are going to 2.7% at the beginning of the year, currently about 15%. Yes, we've backed off from the potential 30% we had, but that's still a massive increase in tariffs. That means that consumers are going to be paying more, reflected in terms of inflation. Companies are going to be paying more in terms of inputs, and that's going to impact not only their revenues, but of course their margins. So am I pleased that they're speaking? Yes. Am I expecting any kind of big agreement anytime soon? No, I think this is going to be continue to be pushed down the line.
OK. Do you think, Guy, the US strategy will be to get tariffs to a... I don't know what the percentage will be, but they will, as you say, they've been ratcheting, they've been going higher, even if they're not as high as they could have been. And to some degree, they're needed because the big, beautiful bill shows us that tariff revenue is something that the government is going to rely on to fix things fiscally. So is that the assumption we make for the rest of this Trump term?
I think the assumption is that we've seen a baseline, probably 10%, and therefore it's going to be 10% upwards in terms of where we negotiate around. We saw it in the UK. I think when it comes to Europe, it's going to be not the 20%, but it's not going to be the 10% either. Either way, we're talking about trade frictions effectively coming through, and that's something that I think is going to be a factor during the term. Now, The good news is, given the levels that we're at today, if they don't get any worse than that, I think we avoid global recession. I think we probably avoid US recession. But just think about this. This means that growth in the US and globally, certainly this year, is going to be slower. It means in the US, inflation is going to be higher, even though it probably means there's going to be deflationary forces at work in the rest of the world, which is not a bad thing if you're a central banker in the ECB or the Bank of England.
Guy, equity markets close to record highs. Is there complacency in the markets given that friction that you expect longer term?
They certainly feel Teflon coated. If you look at the fundamentals and everything that we've been speaking about, you think, should equity markets be close to their record high? Should we be back in bull market territory for the S&P 500? I would suggest perhaps not. But there's no question, when we were down 19%, frankly, institutional investors, including myself, were pretty bearish about the prospect of 30% tariffs. They were underweight positions, and it's taken a lot of time in the recent 2 or 3 months to get back up to the levels that we were at before. In other words, investor positioning has been a key driver, I think, of the rally that we've seen in the last month or so.
Where are we in the positioning in terms of fund flows out of the US into Europe as we see that divergence and the outperformance of European equities versus their US counterparts? Is that a story that continues? Are there more fund flows that you're seeing making their way to European assets?
So I think broadly, fund flows remain decent, and actually positioning suggests that managers are not significantly overweight. There isn't euphoria in equity markets despite this rally we've seen. So the momentum could last for longer, though I suspect that the fundamentals over the summer will question that. To the point about diversification, yes, I think there has been some diversification, which is likely to continue. Interestingly, when we saw that decline of 19% in S&P 500, normally people would use that as a buying opportunity to buy into the US. But actually, the recovery saw European markets, some of the Asian markets do well. So at the margin, I think we've moved just a tad away from that kind of notion of US exceptionalism that we saw at the end of last year.
OK, and Guy, how does that relate to, or is that reinforced by that Clause 899 that we've seen in the Big Beautiful Bill around spending in the US that seems to penalise investors from abroad based on their geography and the tech policies that are in place? As an international investor, you were less inclined to put money into the US as a result of that kind of policy?
I mean, who would have thought we'd be knowing about Section 899 in any kind of bill? But we have to. I think at the margin we saw an undermining of that US exceptionalism for a number of policy measures that we've seen. And this was just another factor around this. We've seen it in the bond market. People are saying, actually, should there be a little bit more of a risk premium in US assets, whether that's treasuries or whether that's equities? And that's a question that we've never had to ask before. This is at a time, of course, that the US needs foreign funding more than ever, and therefore it puts doubt in one's mind. And therefore, at the margin, if you can diversify portfolios, whether it's into Bunds or European bonds or into European equities, I think at the margin that is happening.
OK, and do you think the market is suitably focused on who's going to run the Fed next as well? I mean, President Trump's saying that decision comes soon. There's a lot of chatter around either Kevin Walsh or Scott Bessent.
I think there is a general view that whoever it is going to be sympathetic, shall we say, to the president's views. I mean, obviously, we forget, of course, that he appointed Powell the first time as well. But I think more broadly, there's a bit of complacency in markets about the fundamentals that are going to face us over the next year and a half. And I think that's been underappreciated in terms of risk premiums.
Does that, Guy, just briefly before we let you go, does that sympathy erode Fed independence?
I don't think it does, because it's been very clear, even in terms of the Supreme Court. The Fed is independent. That has been made clear. Were that to be eroded, I think that would be reflected in asset prices. I'm very pleased to say, so far at least, that's not. If it were to happen, I would be very, very concerned.
Guy Miller, thank you very much.
Thank
the
you.
Chief Market Strategist at Zurich. Coming up, ECB Governing Council member Boris Vujčić says the bank should wait until at least September before even discussing its next rate move. More from our interview next. This is Bloomberg.
Welcome back. 30 minutes until the start of European equity trading. Let's look at the futures picture for European equity markets then. And it looks negative. We've actually pulled back a little bit from earlier negativity. Certainly looking at US futures, that's the case. We're down around 0.3% on E-minis and NASDAQ futures, Tom. But European equity markets look to take a small step downwards. Asian equity markets, we saw a small step upwards. Maybe markets just generally a little underwhelmed by what we heard on China, US, but also not destabilised by what we heard there and waiting perhaps for the next catalyst. Perhaps that comes in the shape of the data.
And that sentiment seems to be feeding through to the bond markets as well. Talking the data, of course, we have the inflation data out of the US later today. The focus really should be, I think, on core, given estimates of maybe 2.9%. But Valerie Teitel's going to break that down for us shortly. In terms of the bond movements in Europe, then, just some very mild selling that's coming through. Yields up around 1 basis point across the Eurozone. In terms of the benchmark, Bund 10-year currently yields up just 1 basis point. Over in France, a similar picture, and BTP's at 3.45, yields up just 2 basis points. You do have a 10-year auction out of the US as well later today, before that 30 years. So that's also something to bear in mind. But relative stability across the European bond markets in the session today.
Yeah, long end of bond markets in focus once again then. And the UK dynamics interesting to watch with that spending review taking place later today. We'll see what happens in gilt markets when they open in around 29 minutes' time. As Tom was mentioning, we get the CPI data out from the US. Investors are looking ahead to the US May inflation print today and keeping a close eye on any trade war read across. To what extent then will we see prices higher as a result of companies passing on those tariffs? Let's get to Bloomberg's Valerie Teitel, who has analysis for us. Valerie, good morning.
Good morning, Anna. Yes, that is the big question facing markets today with this CPI print. Just how much will it tell us about corporates passing on price hikes to consumers due to this trade war? We are expected to see a tick up broadly across inflation readings. The year-on-year number is expected to tick up to 2.4% to 2.3%. I'm going to be watching this core CPI month-on-month figure, also expected to tick higher to 0.3% from 0.2%. But just how much of that tick higher is due to tariffs? I was reading a note from Omar Sharif over at Inflation Insights. He contributes around a fifth of that rise in core CPI to tariff-induced inflation. One thing I do want to note, just giving a backdrop to today's print, is that economists have been stepping down their estimates for year-end CPI. It did hit a peak at around 3.2% earlier in May, now down to 3%. So it does seem like economists are revising down their CPI projections for the U.S. economy for the year 2025 as we head into this big print today.
OK, yes, come and join us around the desk then, Valerie, as we carry on this conversation. And Tom, that chart that Valerie was just looking at there, the market's pricing in fewer cuts from the Fed, would seem to fit with an inflation picture that is ticking that little bit higher. As we talked about at the top of the programme, if you strip out food and energy, up by 0.3%, the year-on-year figure up by 2.4%. So it seems as if there is some expectation of that tariff impact.
And it's clearly one of the constraints, isn't it, on the Federal Reserve? That's the expectation, at least from a number of economists that we've been speaking to, which is the relative resilience in the labour market and that slightly stronger inflation print as a result of that tariff input will constrain the Fed in terms of where it goes next on cuts. Val, how are we thinking about what to decode from the inflation data today and how that projects forward on the inflation story for the US as we wrangle over tariffs?
Yeah, it's definitely not going to be easy for the markets or for economists to really parse through this print and give a number of what the tariff-induced inflation is in this print. But it seems like economists are going to be watching a few key components, one of those being cars. We know that there's currently tariffs on automobiles. The other one being apparel. A lot of that is goods imported from China. And lastly, household goods. Again, something very much imported from abroad. Those kind of components might spark, either worries that inflation from tariffs is hitting the economy sooner rather than later, or maybe we'll kick the can down the road in terms of when will we expect this to really show up in the U.S. economy. A lot of economists out there think that the bulk of this might not come until July's print in August.
Yes, and that will be important to keep in mind, because if it is, as you say, there was one analyst, I think it was Omar Sharif you were quoting, who said maybe a fifth of the uptick that we see in inflation will be down to tariffs. I mean, a fifth of 0.1% doesn't sound like very much. And you could imagine that a US administration that wants to convince people that their policies are not going to be too inflationary might push that kind of line, that this isn't having that much of an impact on tariffs. But it's important then to remember that we haven't seen all of the tariffs implemented right now.
Yeah, no, exactly. And I think the other thing that complicates this is most people are going to be looking at core goods, which was actually under a lot of disinflation impulse before the tariff hit. So it's even really harder in the sectors that we want to know information about what's really been driving them, because they were on such a disinflation impulse even before these tariffs at the beginning of the year.
I was going to ask what all this is doing to the housing market, the US, where you have rates, mortgage rates around 7% still. If you don't get a Fed that's cutting until the back end of the year, at what point do you get screaming pain around the housing market of the US? How long is that sustainable?
Yeah, but you have to also consider that U.S. consumers' wealth. A lot of it is in the stock market, and the stock market has rebounded quite strongly. So they might be feeling a bit better about their expenditures because of that rebound so strongly in the stock market.
Yeah, tariff tension. What tariff tension? It seems if you're an equity investor, there are things that are going to be dropping. As you said, there will be some there has been some disinflation even in the things that have been tariffed. But in other areas of the economy, there is an expectation that maybe we do continue to see some deflation. So airfares and hotels, for example, we might not see upward pressure coming from those areas.
That's right. That's more in the services sector where you can almost argue that we're seeing deflation because the U.S. consumer is weakening. The things that you mentioned, like airfares, there's been a lot less travel, especially when it comes to government officials traveling. That's caused some deflation into airfares. But maybe you can attribute that to more of slowing of U.S. economic growth rather than any broad disinflation impulse.
I'm trying to work out whether the Besson and the reporting that maybe he's going to be considered for Fed chair after Powell is good news for the markets or a risk for the markets, given how well many within the markets think he's handled that tension between being loyal to Trump and executing the tariff regime and those, of course, negotiations with the trading partners.
Yeah, he's definitely seen by the market as a safe pair of hands. But again, what you just said there, he's seen as very loyal to Trump. And we know that Trump wants these Fed cuts sooner rather than later. So perhaps if he does emerge as a clear frontrunner, the market might take that very dovishly. Now, there are a few other names in the mix. Kevin Warsh, he was talked about previously as the pick for Treasury Secretary. Kevin Hassett, who's currently at the chairman of the National Economic Council for the White House. So there are a few names in the mix. But again, this just is speculation that Trump wants to have some influence over Fed policy. And the way he could do that is by picking this shadow Fed chair sooner rather than later. So the markets pay attention not to Powell, but to this candidate who is going to come into place May 2026.
Yes, that is the danger for Powell, isn't it? That his role is undermined even before it is lost because of that kind of dynamic. It's going to be really interesting to watch what defines Fed independence, though, isn't it? Because just because you might have political sympathies and have worked for a person does not necessarily mean you follow all their instructions. If it were to be Besson, for example, and just because you might do something that might chime with what the president wants you to do doesn't mean you're not independent. So trying to illustrate that independence, if we did see Besant in the hot seat, would be incredibly important.
Yeah, it would be. And I think this, if we do get a successor named by Trump sooner rather than later, it really poses questions over whether Powell will see out the end of his term. It's something he has said before, that he will sit until May 2026. But how hard is it going to be to do your job when no one's listening to you? They're listening to someone else.
Valerie Teitel, we're going to move on from the Fed to the ECB right now. We're listening to them. Certainly the European Central Bank should wait until at least September to have an in-depth discussion about its next interest rate move. That's the view of Governing Council member and Croatian Central Bank Governor Boris Vujčić. He spoke with our very own Kriti Gupta.
Let's talk about the most realistic circumstances that we've come very close to. And that ultimately is 50%, which is why I come to that number, because that was what was initially levied about a month ago. Retaliation, which the EU has proven that they continue to do in response to the US on various goods. In an era of 50% and retaliation from Europe, is that inflationary or deflationary? How do you think about that?
Is it 50% on everything, or is it 50% on steel and aluminium?
Even if it is steel.
And then the lower on the cars, and then the pharma, a different tariff.
Does that matter?
And then a 20% like it was initially on all goods. It all has a different consequences.
I understand that, but Governor, does that matter, though? Does that matter when at some point, even just the 50%, forget the retaliation for a moment, but the 50% that almost prohibits European companies from exporting to the United States becomes cost prohibitive? Is that not enough for the Monetary Policy Committee to act?
Steel and aluminium, yes. And then that, I would say, invites a response on the side of the Europe. And
what about from the ECB?
As you know, there has been already a package prepared by the Commission on the retaliation on these tariffs, and this was when these tariffs were lower. Now they have been doubled.
Yeah.
So I'm not going to speculate, but then the Commission might double their own tariffs on the selected number of the goods, and then again, sorry for repeating, it depends whether it's aluminium and steel, which will then feed into the inflation in the US, obviously, because aluminum and steel, they go into many products, including the car industry, that is intended to be protected in the US. including the oil production, as you know.
Does monetary policy have any role in addressing that?
Trade is a very complicated thing. I mean, there are lots of spillovers and the diversions when you introduce some of the restrictions to the trade. And the monetary policy, again, has to look at the whole picture. You can say, okay, let's only imagine you have one thing happening, and 50% on and steel and aluminum. How does the monetary policy respond? Because monetary policy will not respond to every single tariff that somebody puts, but it will have to wait again for the trade is a typical example, as we teach students, of the general equilibrium thing. When you touch one thing, everything starts to change. In the end, for the monetary policy, the whole kinds of a general equilibrium thing is what interests us before we can decide what we're going to do.
Do you think you'll have enough data to make that call by September?
No, but by September, hopefully, as I said, yes.
But if the trade volatility continues, to your point, and you have these kind of tit-for-tat tariffs in various sectors, will you have enough information by September to talk about a cut, a hold, or a hike?
Well, there might be a deal, but I'm afraid that easily there might not be a deal, even by our September decision. However, even if there's no deal, there might be, for example, we will see what happens with the largest export of Europe to the US. There's the pharma. Pharma has been under the investigation process in the US. Once the investigation process ends, there will be something coming out, and that will be very important because that's the largest item of the European exports to the US.
The Croatian Central Bank Governor speaking there to Kriti Gupta, and with great insight, saying that there might or might not be a trade deal with the United States, between the United States and Europe, by the time the ECB has to make its next decision. And as if by magic, we have a nice red headline on the Bloomberg terminal telling us that the EU is aiming for US trade talks to extend past Trump's July deadline. Now, we remember that this July deadline came about because, of course, the tariffs that were imposed on so-called Liberation Day were then lifted or given a stay, I suppose, stay of execution for a period until July the 9th, whilst conversations around trade took place. Now, President Trump has said that if these talks don't conclude by his deadlines, then he will just impose terms. So we will see how the US administration responds to this, but it seems that Europe wants more time here.
Eurodollar largely unchanged right now at 114. In terms of the details then on this reporting from the Bloomberg team, the EU sees reaching an agreement on the principles of a deal by July the 9th, that self-imposed deadline by President Trump, is the best-case scenario, and it would allow further talks to work out the details. So they get the principles done by July 9th, best case, then the details.
That might fit with the way that President Trump and the administration has been doing trade deals, because on the UK deal, for example, that was very much an agreement of principles and grand ideas. It wasn't a detailed trade negotiation.
Yeah, I think you have to start with the assumption that if the tariffs are continued to be knocked down and down, so if you think that if the EU is negotiating good faith, that the Trump administration is more willing to press the deadline farther and farther out, to me, that's telling me that this supply shock that could hit the U.S. economy might not come until way later. Even with these U.S.-China talks, the progress is really slow. We know that in the first Trump administration, it took 18 months for a deal.
Yes.
So we could be still here 12 months from now talking about these trade deals.
We could, and you're right if you're looking at the end of the conversation. But what happens to tariffs in the meantime? Does President Trump say, OK, well, we sit on the existing tariffs between Europe and the United States whilst we continue to talk? Or does he say, actually, they go up in the short term? I mean, we just don't know, do we? So, but your point, yes, the time horizon we have to adopt here has to be perhaps a little longer.
Is it better just to have complete clarity in terms of where the tariffs land?
And
is
then
it better,
move on?
Even if they're higher, have clarity, they're set, we move on, we know how to adjust in terms of supply chains and in terms of capital expenditure decisions? Or it's better to have it stretched out with the prospect maybe that you get down to a more modest level?
Or this starts really just putting in doubt the higher reciprocal tariffs, that maybe those were just a bargaining, a way to start negotiations, where really the Trump administration just wants to keep that 10% baseline reciprocal tariff. They didn't really want these higher tariffs. They just wanted to use that as a way to negotiate what they wanted out of these trade deals. And to me, that's kind of bullish.
Really interesting, and certainly really interesting to point out also that we've had this really incredible language being used, I suppose, by Christine Lagarde at the ECB, talking about bullying in global trade conversations, and you wonder how this goes down in Washington. She's been saying that coercive trade policies are not a sustainable solution to today's trade tensions, doesn't cite who she's talking about, but you wonder how that goes down in Washington.
I mean, particularly she's standing inside the hallowed halls of the People's Bank of China in Beijing alongside officials there, so she who gave this speech at the PBOC, of all places, in Beijing, and kind of taking a swipe at the US, and to some extent using China's own language, though she did say that countries that have those surpluses need to look at addressing those as well.
Yeah, so it's funny that the ECBs might be using some language that would maybe appease China as she's there on her visit.
Valerie Titel, thank you very much indeed. The breaking lies, of course, and Valerie's reaction to that in terms of how to think about the markets as the EU looks maybe to extend the conversations with the Trump administration past that July 9th deadline on additional tariffs. Coming up, UK Chancellor Rachel Reeves sets out her spending plans for the next 3 years. We're going to give you a preview on what to expect. This is Bloomberg. The UK Chancellor, Rachel Reeves, is set to outline how £600 billion of annual spending will be allocated across departments over the next 3 years. For more, I'm joined by Bloomberg's James Woolcock, who's been looking into the details of the preview for us. What can we expect then from this pretty crucial spending review from the Chancellor, James?
Well, look, UK spending in the state makes up a fifth of the UK economy. Now, we know we're going to get £200 billion going to the NHS, £39 billion to defence, £94 billion to education. That's about half of the budget. We don't know is where the cuts are going to come to make that all add up. We're also going to see, from the financial side of things, £113 billion on capital spending. Think rail, think green energy, think energy national grid. That will be interesting where it all gets allocated. But on the other side of this, it's going to be money going outside London. The Chancellor has been very clear this is about levelling up. It's also about government efficiency. The FT say 1 in 10 civil servants could face the axe under these kind of plans laid out today. OK, she's going to want to talk about infrastructure and productivity, but a lot of the conversation, this on the back of some weak labour market data, could be about something else. Well, weak labour market data and weak labour polls for the government. I mean, the Chancellor is now as unpopular, according to Ipsos polling, as Kwasi Kwarteng after the mini-budget. That is a dramatic fall from grace, one that's barely been seen in modern UK political history. This is the comeback moment, if you talk to people in Labour. This is the moment they spell out what the government looks like for the next 3 to 5 years. The last one was done by Rishi Sunak in COVID. Before that, 2015, pre-Brexit, Anna. This is where we will see where Labour put the money for the next 5 years into the election. They cast the political die, and we'll be watching to see how they make their sums add up, potentially tax rises in autumn. And how they defend the fiscal decision-making then. James, thank you very much. Bloomberg's James Woolcock with a preview of what to expect on the spending review here in the UK. Let's talk about the broad market picture. Our Markets Live executive editor, Mark Cudmore, joins us now for 3 minutes on the markets. And Mark, we're just moments away from the start, or minutes from the start of the European trading day here. I guess CPI hangs over these markets as the big set-piece event?
Absolutely, it's CPI, and then, of course, the Treasury auctions. There's a 10-year today, a 30-year tomorrow. So I think that there's a little bit of bias towards yields to rise, but that's obviously with no kind of prior knowledge about what CPI will print. I also think there's a little bit, but probably bias for stocks to go down at the margin, but not very strong. In terms of that, there's a soft CPI print. It'll be about softer readings and services dominating the goods inflation, whereas if it's a hot CPI print, well, the jump in yields will pressure stocks. But I still feel that overall we're kind of in limbo. We're looking for the next driver. So we get CPI and auctions, but they don't feel like they're the big macro change. We're waiting to get clarification on what the real trade story is, and I don't think we've got that yet.
Mark, on that 10-year auction and then the 30-year later this week, how much has been priced into the markets in terms of the deficit and debt concerns of the US as that bill works its way through the Senate? I mean, I guess, how much further is there to go, potentially, for yields higher at the long end?
I think long-end yields will rise significantly further over the next year. I think that the backdrop is increasing kind of fiscal and debt concerns in a slowing growth world. But that's very much a long-term picture. I think in short term we haven't necessarily priced loads. But that makes sense. Remember, this is, it's negative carry to just kind of short bonds. So you want to wait for the catalyst and the impetus. It is much better to kind of wait for the negative headline and then trade it aggressively. And we've also got so much uncertainty about the tax bill, the fiscal side, that people don't want to rush that trade. But I think whatever happens, we are going to be kind of worried about the yield situation over the year ahead. It might just be worried about the long end. If we have very aggressive fiscal expansion, it might be worry right along the curve. But I don't think it's a theme to play too aggressively just yet.
OK, yeah, something to watch, though. Mark, did you have high expectations that we would get tariff certainty in the short term? And has anything you've heard from either China-US talks or the latest news lines around Europe, has anything changed your thinking about when we get to the end game?
No, I had very low expectations. I don't think they've necessarily disappointed those low expectations. They might have marginally exceeded in terms of that we seem to be really accelerating. People seem to be making an effort to make a deal. The compromise or the peace between US and China was better than expected. So I think the marginal news flow over the last month or two is good. But the backdrop is tariffs have already jumped massively. The level of tariffs in April, the average effective tariff rate for the US in April, realized average effective tariff rate, was over 7% for the US across all trade partners. For China, it was the high 30s. These are incredible levels. So overall, this is an increasing cost of business and there's an increasing cost to corporates and to stocks globally, particularly in the US.
OK, the increasing cost of business. Bloomberg Markets Live executive editor Mark Cudmore with a nod ahead to the CPI data and, of course, a focus on the auctions 10 and 30 later this week, the 10-year today. Remember, of course, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Yeah, some of the numbers out of Inditex, the Zara owner, of course, seeming to meet estimates. Is that enough to keep stocks at elevated levels, though, in this current trading environment? We'll get to the opening of these European markets shortly, including the share price of Inditex. We'll check in on that. This is Bloomberg. Welcome back. This is the opening trade. A few minutes ago until we get the opening trade here in Europe. Let's recap what we saw during yesterday's session and ask whether it has any bearing on where we go today. The US session you'll see in the blue, not giving us a huge amount of direction, really. And a lot of the catalyst for today's trade maybe came after hours in the US, well, actually here in London, in the shape of those US-China trade conversations. That could be something that weighs on sentiment a little bit. We've seen US futures down around 0.3% through the morning as we've been dealing with the headlines coming through on China-US trade. What does that mean for Europe? Well, we could go a little bit weaker at the start of the European trading day. We've seen a constructive tone to those conversations, Tom. We've seen some de-escalation, perhaps, in that China-US relationship, and certainly this specifically matters around rare earths and magnets and chip exports, but the wider implications of this yet still unclear in terms of the broader trade narrative from the US administration, I suppose. And with that in mind, then, futures do point a little bit lower here in Europe. Yeah, and trade and tariffs part of the conversation, at least when you look at some of the corporates out there, like Inditex, the parent company of Zara, of course, coming in with their results a little softer than the estimates. So that's one of our stocks to watch, Inditex and the parent company of Zara. Publicis winning over a deal from WPP. So that company in focus, the Mars advertising deal, and a sizable one at that as well. So watch Publicis over in France. Defence stocks getting a downgrade, interestingly, from Deutsche Bank, saying that they are now looking at steep valuations and that much of the spend from Germany has already been priced in. So also watching the defence stocks, Anna. OK, so from apparel to advertising to the defence sector, plenty of companies and sectors in focus as we get ready for the start of Wednesday's trading session. Expecting a little bit of a retreat. We're waiting for the CPI data out of the US. We're waiting for key auctions in the Treasury market out of the US this week. And so all of that could be material for where we go on equities as well. Just getting the FTSE 100 opening up and opening just a fraction to the upside. But we are expecting a little bit of downside as we reassess, take stock of where we are on the global trade narrative. I've talked about China-US and how we made progress on some specifics there, shoring up the Geneva agenda, Tom, but not really any big progress or any big resets in that relationship, perhaps might be some people's conclusion. And then since then, we've had these headlines around Europe suggesting that Europe wants to push out the deadline for trade narrative, trade conversation, to beyond July the 9th. How that will go down with Washington, with the US administration, we'll have to wait and see. But does this mean we reset our time horizon when it comes to getting to the end game on tariffs? So as we deal with all of that,
European markets maybe surprising us slightly to the upside, certainly on the CAC 40 up around 0.2%, and the FTSE 100. The IBEX down by 0.3%. And of course, we've heard from Inditex today, and I did see some opening calls suggesting that could be a little bit weaker on the inline numbers that we got there, Tom, from that particular business. And that can be a business such scale that it can weigh on the whole sector.
And that is exactly what is happening. It's down right now, to your point, Anna, 6% Inditex, as they come out with those earnings that miss estimates marginally, but it's the caution ahead, of course, for this company facing the tariff and supply chain challenges, the FX impact as well, given, of course, stronger euro, I should say, weaker dollar, and the moves around the Mexican peso also in focus. So Inditex is one of the stocks on the move today to the downside. To your point, on a more broader picture across these indexes, some modest gains coming through for the FTSE 100, 8,875 right now for the UK index, up 0.3%. We have Rachel Reeves, of course, in the spending review and the capital expenditures details coming out later today. Over in France, the CAC 40 is up 0.2%. The DAX in similar territory so far, adding 49 points. On the sector story, it's autos at the top of the list so far, up 0.7%. Basic resources also getting a bit of a lift, up 0.4. On the downside, retail, and we can again tie in the Inditex story to that. Retail as a sector down 2.3%. That's the biggest loser across your sector so far in the session, Anna.
Yeah, it does absolutely seem to be that Inditex move is weighing on that whole retail sector, isn't it? Because Inditex is down by over 6%, Zalando down by 2%, H&M down by 1.6%. So it is having an impact on the rest of the sector, and it is the standout negative sector. It's down by 2.3% as a whole because of the heavyweight that Inditex plays there, I suppose. There aren't that many sectors in negative territory, though. The balance of things perhaps skewed a little bit more positively than anticipated. Basic resources up around 0.5%. Banks up 0.4%. Chemicals, technology, a range of sectors moving a little bit higher. But we're pretty flat, though, overall on these European markets right now. Let's get to Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, who joins us to make sense of all of the inputs into our market conversation these days. Karen, thank you very much for joining us. Help us understand, give us your perspective on what we've heard overnight on trade then, because on the one hand you can spin this as de-escalation, these talks still ongoing, constructive relationship, positive language being used by these two sides, which of course is really important. But on the negative side, this is just shoring up something we knew about from Geneva and no new progress was made.
I think that's right, and we're just releasing our mid-year this week, and the key theme of it is sometimes uncertainty and not having a conclusion can be worse than having an adverse outcome, because at least when you know what's going to happen, you know what the tariff is with your trading partner, businesses can plan, they can do things. But actually this extension of timelines, not knowing exactly what the tariffs will be on different regions, that I think is the danger for the second half of the year, because what happens in uncertainty is companies, households move into I'll wait and see mode. And wait and see can be incredibly damaging for expansions, because companies stop investing and households stop buying clothes, as we've seen this morning. And so that, I think, as we now start to think about the data, we've been in the policy space, our head has been in the policy space, as we now start to think about how this is going to play through the economy, how much is it going to damage growth? But maybe, as we highlight, is the market once again being complacent about inflation?
Yeah, that's really interesting. I was reading a Bank of England piece yesterday talking about UK households hoarding cash, to your point about what people do while they're waiting for certainty. Tom was raising this point. When we saw this red headline earlier on today, Karen, about how Europe might try and push trade negotiations beyond July 9th, Tom was asking that question about, what does that do to investors and to corporates when they're thinking about their planning for the year ahead? They don't have that certainty. I suppose I'm then minded to ask, should we not let the perfect be the enemy of the, well, maybe not the good, but the decent when it comes to trade conversations? Is that where we get to?
I think that's exactly right. I think at least having some, clear time frame, what the products are in scope, what the kind of numbers, is going to be much better than just having this continual extension of deadlines. Because what we absolutely don't need for this expansion is companies to stop investing. We were just post-pandemic, just getting on that global, not just US, but global upswing in investment. It's what we all desperately need. Productivity, investment. And this is just going to, I think, quash all that, which then plays into some of our big investment themes. One of the things we're concerned about is we know that the darling of the market have been these tech companies. Never before have we seen a CapEx downturn and tech earnings prove resilient. which does not fit with the valuation of some of those mega cap techs. So, you know, how this uncertainty plays into not only the economic outlook, but some of the big positions that are out there is something I think the market's not quite ahead of.
Are earnings expectations looking a little rich then, given that backdrop?
It's very hard to square the circle of what tech earnings expectations are with the trajectory for the US economy slowing down, particularly a capex-focused slowdown. So if you're of the opinion, which we are, that this slowdown is going to cause companies to wait, to postpone their capex spending, unless they absolutely prioritise within that their AI spend, then yes, those expectations do look a little lofty.
What is your view right now on US recession risks? Are we through do we have a clear steer in terms of a US economy that is actually holding up a little better than maybe some would have expected, given the tariff impact?
I mean, I think the data at the moment have been so clouded by the front loading, everybody getting stuff done now because of problems that could happen with tariffs and pricing later on. So I don't think the data up until now give us a good steer. Our core expectation is it's a slowdown rather than a recession. I think what's really going to prove interesting and critical is the role of the labour market, because I suspect, you know, the other policy, of course, that President Trump is doing is really trying to curb migration. I think that will create a sentiment of labour hoarding. Companies in the US won't move to firing as fast as they might normally do, and that sort of cushions the downturn. But that comes back to my point then about perhaps what the market's underestimating is the inflation risk.
Karen, let's pivot the conversation to the UK, because we're going to get a spending review here. And I know you've plenty of experience of talking to policymakers about what they need to be thinking about and investing in. What are the investment decisions that you'll welcome, and what are the pitfalls that the government needs to watch for when it's allocating this money?
I mean, prioritising investment and making clear that in all of the difficult decisions that's not going to be the first thing to be cut is really important. You know, our problem here in the UK is productivity. Productivity is the secret sauce that makes everybody happier. Retirees get their pensions, workers don't have higher taxes. We've got to get productivity going. And anything that can help with that, we need investment, and government investment should stimulate private investment. So I think a clear signal that that will be prioritised will be very, very good. Other than that, though, Anna, we're on to the sort of perennial conversation about how we have an ageing population. That means yet more money for the NHS. Squeeze on all other aspects of spending. I mean, honestly, it's like I feel like every year that, you know, the daffodils come up in February, and then in autumn we're going to be discussing whether taxes will go up to pay for the fact our population's ageing.
And so it doesn't sound as if you think this is much of a game changer, spending review?
No.
New administration, new government. I mean, I say new, it's been a year, but this is the first big spending review, isn't it?
Well, it shows us, it doesn't tell us much about the envelope. That was set in the budget. But it tells us the priorities of this government. But the priorities are dictated by the electorate. And the electorate, as I say, are ageing. The voting population is largely of the older cohort. That is, therefore, will decide the government's priorities, which is the same as all governments that have come before. So it's really just going to reveal this familiar theme, which the nation really just doesn't want to engage in, which is that we have more people retiring and drawing on the state, fewer people entering the labour market and paying into the state, and therefore the numbers just don't add up. And that doesn't add up for Rachel Reeves. It's not going to add up for all of her successors.
Karen Ward wants us working till our 80s. That's the message I'm taking from this. Guys, wake up, 80s, into your 80s, in terms of trying to close that gap. Karen, look, you've mentioned inflation a couple of times, and we haven't taken the bait yet. What you're really concerned about inflation. That's coming through in your conversation with us this morning. What is your preferred kind of inflation hedge at this point?
Yeah, I mean, maybe just the background on it is we have been here before. We've had a supply shock coupled with a fiscal boost. We're reducing the supply capacity of the economy whilst pumping fiscal policy. That happened in 2022. What was the outcome? Oh, gosh, inflation. What a surprise. What worked in 2022? So that's one of the big chapters in our outlook. Let's learn our lessons from 2022. What worked? Now, obviously, a lot of investors have been already attracted by gold, but that's looking pretty expensive. In our view, it's the real assets, those that genuinely provide you inflation protection, whether that's core infrastructure, timber, transport assets. Those are the ones that genuinely reliably work in inflation surprises and inflation shocks. So that's where our interest is. And that's the key point we're making in this outlook, is there are still recession risks, but there are inflation risks. construct your portfolio such that you're going to be covered for recession, covered for inflation, and then turn all other news channels except Bloomberg off. Really got myself in trouble there. Because you know then you're covered.
Yes. Okay. Seems yeah, good, interesting advice. But on the inflation side of things, I hear what you're saying about being a little alert to the inflation risks. But we were having a conversation earlier about how much pass-through we're going to see, for example, in CPI today. Now, maybe it's all still to come, but one estimate that Valerie Titel was looking at said a fifth of the uptick in inflation today is going to come from tariffs. It's a fifth of a 0.1% increase in the rate of core inflation over in the United States. This doesn't sound like, political career-ending inflation, that level of inflation.
I don't think it's going to be the magnitude that we saw in 2022. No, absolutely. But I think it's going to take a little bit more time to feed through. But if you look at some of the more forward-looking indicators, whether it's the PMI business surveys of input and output prices, they're pushing up. But Anna, as I say, to me, it's remembering that what bailed the US out from an inflation problem last time was a massive surge in migration. They had no supply, inflation was pushing up, the labour market was tight, and then they had millions of migrants arrived to ease that pressure and cool inflation out of the system. That's gone. There are no migrants arriving in the US. So now we're in a very tight labour market. We're once again going to push some cost pressures onto households. And I think where the surprise will come, Anna, and probably not till later on in the year, is when those workers start to say, I'd like a bit more money again. And that's when we really start to worry about inflation.
OK, Karen, thank you very much. Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management. Tom, let's have a quick look at some of the core six then. In Guy's absence, we'll still keep an eye on his six picked stocks. We've got a mixed picture, actually, coming through in a market that's pretty flat, so that shouldn't be a huge surprise. A bit of upside in some of the tech names, so ASML, for example, going a little bit higher. Schneider Electric moves higher this morning. We're seeing some of the more defensive sectors in retreat, so Novo Nordisk, Nestle, pharma and consumer goods, both of those a little weaker. I'm not sure we see a huge amount of pattern coming through in those. Let's just get to a red headline that we have across the Bloomberg terminal, shall we?
Regret from Elon Musk. He has posted on X, his social media platform, of course, and I'm quoting from this post, "I regret some of my posts about President Trump last week. They went too far," says Elon Musk. Of course, this was the story that dominated the breakdown in the relationship between the world's wealthiest man and the most powerful man last week, I should say. Now Musk sensing some regret. In terms of that breakdown, it was, as dramatic as it could get in the moment, and it seems like both sides are walking back to some extent. Interesting, I was speaking to Kathy Wood of ARK Investment, a huge backer, of course, of Musk and everything he's doing across his businesses, yesterday. She said, yes, this did go too far and that they needed to resolve this conflict, and she pointed out that SpaceX alone gets $22 billion of contracts from the federal government, and there's the vulnerability should this dispute go on. So Musk seems to have realised at least that part of the equation, saying he regrets some of his earlier comments and social media posts about the president. Yeah,
this started to get quite real quite quickly, didn't it, for Elon Musk? He came out fighting against the president, and then the president threatens to go back on some of the contracts that Musk has been rewarded. So we wonder which of these posts in particular he regrets, but we will leave that one there. So Elon Musk with his regrets this morning. Coming up on the programme, Inditex shares slump after it reported first quarter net sales that were lower than analyst estimates. More on the world's largest listed clothing retailer. That's coming up next. This is Bloomberg.
Welcome back to the opening trade. We are 17 minutes into your Wednesday session. European stocks are flat, essentially, after a similar picture yesterday. Let's see if there's a catalyst for these markets. US-China trade talks, of course, wrapping up after 2 days. We look ahead to inflation data out of the US later today, Anna.
Yeah, are we back to thinking about the data, or do the catalysts for the market still come from the White House and the trade narrative? Well, let's talk about some of the individual corporates that are on the move then this morning. Tom, we have Publicis from the advertising space, some headlines there for that business. Publicis has won a $1.7 billion ad portfolio for Mars. This is from WPP. So previously Mars was advertising with WPP. Now that goes to the French-listed Publicis. They'll be handling media, production, paid social media, influencer ads and the like. So that stock up by 0.6% as a result.
defence stocks actually performing relatively well across the session today. You can see the gains coming through. For the likes of Hensoldt up, 6.5%. This is despite the fact that Deutsche Bank analysts have come out and said valuations are now looking a little stretched in the defence sector. We know, of course, this has been a key trade for many investors on the back of expectations around fiscal stimulus from Germany. And Deutsche Bank saying a lot of the expectations, a lot of that money that Friedrich Merz and the German government have promised has already been factored into the price action when it comes to defence stocks. Nonetheless, you're seeing some pretty decent gains in the session today.
Yeah, so we were asking, weren't we, whether the defence sector would have another negative day, and no, it seems to be the answer to that one. Yesterday we saw those stocks on the back foot. Also not on the back foot today is Bayer, the German business, and we see that share price is up by around 1.9% for this large pharmaceutical business. And we've seen some analyst changes here. So it's been raised to a buy by Kepler Cheuvreux. Price target set at €33, which is a little above the 27.26 that it trades at right now. So we will keep an eye on that one as it responds a little to some of that broker move.
OK, let's get to another corporate story, another stock on the move, and firmly to the downside. That is Inditex, the parent company, of course, of Zara. You can see the drop there. Wow, 5.3% after reporting operating profit and revenue in line, a little bit softer, in fact, than the estimates. Sales did pick up in the early weeks of the second quarter, but investors are clearly concerned going forward about the prospects for this business. Charlie Wells is here to break things down for us. Talk about the report, what it means for Inditex and the share price reaction.
Yeah, Tom, so I guess this morning what we're seeing is this report just wasn't good enough, right? Yeah. There just wasn't enough of an acceleration factor here to kind of help the share price. We're seeing, a significant downturn there. And, look, Inditex for a long time had been this sort of industry darling within fast fashion, right? They really kind of bolted out of the gate after the pandemic. Their share price had really been kind of significantly higher than a lot of the other peers out there. And this is just seeming like these trade war tensions that we're hearing about may also be eating into the demand of this consumer. And I mean, Inditex had been in this sort of unique position where they have this, integrated supply chain. They are less exposed to China than a number of their peers here. But really, it doesn't seem like this report is kind of helping to kind of, set off some of the concerns that we've been seeing. And even the summer sales figure for that current quarter, just not as high as the year before. So that is posting soft demand.
And how does the performance of Inditex then, how does it compare to the rest of the sector, Charlie?
Well, look, I think investors have been asking this question, not just about fast fashion, but about fashion more broadly. As these earnings reports have come in, what is the narrative? I think there have been a lot of kind of divergent stories here. And one that we're seeing, and this report really does kind of feed into this story, is this idea that the high end and the low end are struggling, but you're seeing this kind of success in the middle market. So the parent of, say, Michael Kors or Ralph Lauren really kind of benefiting here from that higher income consumer sort of trading down a bit. So looking for kind of, value, but at that lower price point.
In terms of how the company is positioned going forward, given some of the challenges around tariffs, supply chains, FX effects, this is something that was flagged in the analyst notes this morning, wasn't it, in terms of the currency effects? How are we thinking about what could be the headwinds or indeed the tailwinds for the business in the months ahead?
I think currency is really important to pay attention to here. So in that report, they talked about a 3% hit to earnings in the year ahead because of currency. And there was, that idea that having this integrated supply chain, very Europe-focused, is a benefit to this company. But at a time when the euro is strengthening, at a time when the U.S., where we're seeing that dollar weakness, when the U.S. is their second most important market, that is a headwind that they are signaling this morning.
Charlie, I'm looking at some of their top-selling items on the website right now. There's a Western shirt.
I'd take it.
Western shirt. You can do a Western shirt. You've got a polka dot shirt as well, which is standard. Denim jeans. Shorts. Do we do denim shorts?
Nice.
With sandals? Is that allowed?
It's been a while, but I think those are back. And this is something that Zara does, right? They try to respond really quickly to a lot of these fashion trends, but also that can hurt them if some of the trends don't pick up.
So you're confessing to just basically being sitting around the desk just shopping this morning then, Thomas? That's what's
I
happening
may have
here.
taken this as an excuse to look at this Father's Day coming up, isn't it? So you've got your wish list.
Yeah.
Charlie Wells, thank you very much indeed. On Zara, parent company Inditex, the stock is down in the session today.
OK, Blackstone is planning to invest as much as $500 billion in Europe over the next 10 years. Another sign of the continent's growing appeal to investors during a period of geopolitical flux. Chief Executive Steve Schwarzman spoke to Francine Lacroix about the plans.
We started here with no one. We now have 650 people here in our office in London. We're building a very significant new headquarters in Berkeley Square. That's probably going to be the nicest office building that's been built really since the wonderful Bloomberg headquarters here in London. So that's worked out. We're in a lot of different business lines, and we have a very positive view of the future here in Europe. We think we're going to be able to invest $500 billion over the next decade in Europe. We see it as a major opportunity for us. They're starting to change their approach here, which we think could result in higher growth rates. So this has worked out amazingly well for us.
Where do you see the best opportunities in the UK and Europe? Is it certain sectors? Is it certain parts of the economy?
Well, we see in real estate, there's always opportunity as you go through cycles. We've been looking on a global basis with very similar themes. With artificial intelligence, I see that Jensen Huang was here meeting with the Prime Minister at a tech conference and was talking about how the UK needs to invest more in infrastructure. Blackstone is the world's largest developer of data centers, and we're also the world's largest owner of data centers. So it's been a really core business for us.
It's been a pretty subdued year overall for deal making. So how do you approach monetizations, for example, at a time of heightened demand for liquidity from investors?
Well, we're in a cycle now where the markets haven't been accommodative to IPOs, and the strategic sales to other private equity firms are difficult because they're having difficulty raising money. Fortunately for us, we finished our money raising cycle, so we've got lots of money at the firm for these things. We're in an unusual position. But I think we sort of look at these things and say we sell companies when we think it makes sense. No. We've actually sold a good deal, surprisingly. It's because we have some very good companies with very good results.
That was Steve Schwarzman, of course, Blackstone's chief executive, speaking to Francine exclusively. Coming up on the programme, the US and China agree on a preliminary plan to ease trade tensions, shoring up that Geneva agenda. But markets are taking the outcome with a pinch of salt in their stride. US futures pointing a little bit lower this morning, down around 0.25%. We'll dig deeper into what this means specifically around rare earths, magnets, tech, jet engines, and more broadly for the trade narrative. This is Bloomberg. This is the opening trade, 30 minutes into our European session then. And European stocks actually a little brighter than maybe we had anticipated. US futures still pointing a little bit lower, but we do have basic resource stocks, technology, consumer products and services, giving us sufficient amounts of positivity to move us higher this morning. Let's talk about the broader trade narrative, though, because we've had headlines from that overnight, deep into the night here, London time. The US and China have agreed to a preliminary plan to ease trade tensions, which now goes for approval to both of the nation's leaders. American negotiators say they expect issues concerning rare earths and magnets will be resolved.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way.
In the past 2 days, China and the US teams had in-depth exchanges. Our communication is very professional, rational, in-depth and candid. Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th at the consensus they reached in Geneva.
All sounds very friendly. For more, we're joined now by Bloomberg's Lizzie Burden with details. Lizzie, what details did we get then about these discussions?
Well, after 20 hours total of negotiations, Anna, you had the US Commerce Secretary Howard Lutnick and the US Trade Representative Jamieson Greer emerging to cast this as a framework for implementing the Geneva Agreement, that 90-day tariff truce through which we're about a third of the way. And as you heard there, it's essentially China agreeing to send more rare earths to the US, and the US in exchange rolling back some of the export controls that it had introduced in retaliation. But the question now is, what if the relationship blows up again, as we've seen it do since Geneva? And it's not encouraging, perhaps, that Jamieson Greer says there are no more meetings in the diary for now. I think what's really crucial, and I've said it before, I'll say it again, is just how important export controls have emerged as a front in this trade war. Tariff may be Donald Trump's favourite word, but Beijing has just showed how well export controls can give you leverage in modern trade warfare. And now you've got the US trying to rustle up deals with other countries, whether it be South Korea, India or Japan. But President Xi's on the phone as well. He's been talking to the newly elected South Korean leader too. And the bad news for Donald Trump this morning is our colleagues Alberto Nardelli and Jorge Valero report that the EU actually sees July 9th, that reciprocal tariff deadline, as the best case scenario for when they could reach a US-EU deal. So perhaps that vindicates some of the economists who've been criticising the ECB's scenarios, which sees 50% tariffs, not even in their most severe scenario, all of which to say, Anna and Tom, is the road ahead could be pretty rocky.
Yeah, and to your point, if tariffs are Trump's favourite words, maybe samarium or scandium are the favourite words of President Xi Jinping right now. Rare earths he's using as leverage. Bloomberg's Lizzie Burden, thank you very much indeed. Let's get more on this and bring in Charles Parton, Senior Associate Fellow at RUSI. Charles has spent 22 years of his 37-year diplomatic career working in or on China, Hong Kong and Taiwan. So, Charles, drawing on that deep experience and your granular understanding of the CCP and the workings, of course, of the inner halls of Beijing, what is your assessment of where things stand between the US and China after these talks?
Well, I think I tend to agree with your correspondent, Lizzie Burden. There's a lot of possible potential trouble on the horizon. I mean, the media talks very much about a trade war or a tariff war, but I think that the Chinese certainly, and I suspect the Americans do, the Chinese talk about a science and technology war rather than as much as a trade war. And indeed, I think it's much broader than that. It's a fight between, if you like, between systems, political systems and economic systems and value systems as well. So whatever the the external propaganda says, the voice of the party, the Chinese Communist Party, talking abroad about win-win or a community of shared future for mankind, etc., underneath, when you see what they say to themselves, they look on this as a struggle, and it's a very strong word, against hostile powers, and that's America and any of the allies that line up on the American side. So both sides, quite rightly, I think, coming back from the brink because China has a very strong weapon in the rare earth exports controls and bans, and it's shown its sword in that area. And the Americans can do quite severe damage to the Chinese economy in the short term through some of their semiconductor technology, aircraft parts, ethane for plastics, etc., etc. So they've rode back from that, but I don't think it changes the underlying hostility between these two powers, where the Chinese see America, probably rightly, as trying to contain their rise and oppress their rise, and the Americans, quite rightly, seeing the Chinese as threatening their position as the global big power.
Yeah, Charles, and I think there's real value in framing it in terms of that longer-term positioning between these two superpowers. The here and now question around where China is feeling the pain, whether it's tariffs or those export controls that the US is putting on. Which of those is the issue that China wants to address most quickly? Which is the one that is of most concern? Is it the tariffs, or is it those export controls, whether on aircraft engines or on semiconductors?
Well, I think it's both. I mean, China is always very worried about the employment situation within China. It's not good at the moment, the economy, and unemployment is particularly high. And we've got a whole load, 12 million or so graduates graduating very shortly will also be on the job market. And if you don't have a very good social security system, which they don't, and you've got massive unemployment, then you've got a lot of very unhappy people. And since all good things come from the party, then also the flip side of that coin is all bad things will be blamed on the party. And so it'll be directed at the party. That's a great worry, because it is fundamentally quite a brittle regime, and worries about protests and the potential overthrow are demonstrated by the vast amounts of money that they spend on control and repression systems. So, but in the longer term, yes, I think they are, that they understand too that whoever's going to be the more powerful country in the future will be the one whose science and technology is dominating, and particularly the industries that depend from those new sciences, and possibly, or definitely, in terms of energy, and who has the right energy supplies, including, of course, all the new energies, solar, wind, nuclear, etc.
Yes.
So, that the worries are both short-term and long-term.
Charles, do you have a sense of how we get to the next stage in the trade conversation? Because we've heard from members of the US administration that there aren't further talks planned, but we know that a deadline looms on, well, at the early part of August. And if we don't have any kind of conclusion of the trade relationship conversation before then one assumes you default to higher rates of tariffs. Do you have a sense of where the off-ramp is?
Well, if you look at what's happened over TikTok, for instance, which also had a 90-day deadline on it, that's been extended. There's no reason why I think it's August the 9th deadline cannot be extended for another 90 days if possible. But I think, as you said right at the start of the program, President Trump quite likes tariffs, so I think it's very unlikely that they're going to disappear in entirety. They're now down to 30% against China. I suspect that sort of level will be maintained in the longer term. But I think, as I said, the underlying tensions between them mean that we will see flare-ups and reconciliations continuing, because that's the nature of the,
okay.
To be frank, a Cold War, one has to say. It played out in a different way than the earlier Cold War, but nevertheless a Cold War.
Right. And the relationship is much wider than just the trade relationship, Charles. But if we did see tariffs of 30% sustained, if that's the future, how does that reset? It might reset the balance of trade, and how might it reset this relationship between the world's two largest economies?
Well, as I say, I don't think it's going to. In a sense, it will be reset, because that in a state of sort of muted hostility. I think the other question that's actually really quite interesting is whether what the pressures will be on Europe, because I think it's quite clear that both sides will want us preferably to choose sides, and certainly not to choose the other side. And that was made clear, for instance, by the Chinese when the UK made a trade deal, reached a trade agreement with the United States, and we received warnings about not getting too close to the United States. But then if you look at what, for instance, Scott Bessent has said, and people like Brendan Carr at the Federal Communications Commission, which is also very important, they said you better not cozy up to China. And I think people kind of miss also, there was a very interesting memo which went out of the White House on the 21st of February, it's America First investment policy. And there's a couple of little paragraphs in there which say, and by the way, allies, you're very welcome to invest in us, but not if you've got Chinese technology there, and not if you're cozying up to America's adversaries. So, yes, here in Europe, we're going to have, I think, to choose. And
okay, so we will be presented with that choice. Charles, on this point, European leaders heading, of course, to China in the coming weeks. They will be in Beijing. You've played that advisory role to the EU as well in the past. How far can Europe push that relationship then on the trading front with China, given that pushback and those constraints from the US?
Well, like the United States, Europe has seen what happens when China takes out its rare earths export sword from its scabbard. I think one can say that the Chinese deliberately showed the gleam of that sword in the last few weeks to Europe as well. And many companies in Europe have been clamoring, one might say, panicking perhaps, about the supply of rare earths where the license has been held up in Beijing. And Beijing, of course, will say, well, that was just because of the sort of general rise in demand and chaos and the need to go through the bureaucratic hoops. I don't think anyone should necessarily be fooled by that. It's definitely been a warning. Europe is and the United States were in a weak position over rare earths. We were warned back in 2010 when China used rare earth export controls against Japan over a fishing dispute. And we've done nothing about it in the intervening 15 years. I think we're going to have to. And you might say that as Europe raises its defense budgets from whatever they are to 2 to 3 and possibly a higher percentage, well, maybe a good part of that budget will be spent on ensuring that we and our allies, the United States, have access to rare earths. So that would be money well spent under a budget heading, let alone under an economic security heading.
So you're saying that Europe will need to choose, Charles, and that might seem like a straightforward choice between an ally and a country that isn't an ally, traditionally speaking. But as you set out, there are economic implications. Can Europe scale up access to alternative rare earths quickly enough to enable it to make that choice?
It's going to, of course, it's not an easy and clear choice at all. There are going to be great pains in this inflicted by both sides of America and China if they're not happy with Europe. And of course, when we say Europe, well, who are we talking about? There's the UK, of course, and we're now outside it. But within Europe, there isn't a united position either, because if you look at countries like Hungary and Spain in particular, they are certainly taking different positions from some of the other major countries. And even within Europe, when one talks about countries, perhaps one should also talk about industries and big companies, because these days they also have immense powers, not least to influence the government.
Charles, thank you very much. We appreciate your time. Charles Parton, Senior Associate Fellow at RUSI. Coming up on the programme, the UK Chancellor Rachel Reeves will defend her fiscal choices when she sets out her spending plans today. We'll speak to the UK Treasury Select Committee Chair, Meg Hillier. That's next. This is Bloomberg. Welcome back to the opening trade, Wednesday the 11th of June, and we have modest gains across some of these European equity markets, but overall we move nowhere. To the downside, the Spanish market providing that. The IBEX down by 0.8%, so the Stock 600 overall is flat, despite the green on the screen that you see there. So the IBEX story, the Inditex story, is the negative one. Elsewhere, a little bit of positivity perhaps. But US futures point downwards. Tom, let's just go through what we have ahead on the trading day. We've got the UK spending review coming up. US CPI, of course, a US Treasury auction and the US federal budget balance, all that very much in the mix. Let's get to Valerie.
Karen Ward as well, Valerie, of JP Morgan, warning about the inflation risks and really trying to draw a line under it and saying, look, the markets are underestimating the inflation risks because of a number of factors. She talked about the immigration crackdown in the US as part of that, which, of course, ties into the protests in Los Angeles. What are you looking at when it comes to the inflation data? How far underneath the hood do we need to be looking to get a clear gauge?
Oh, look, I think there's going to be a lot of nuance in today's print because it's not just what the headline numbers are going to be, but it's parsing through those components that maybe led to a hot or cool CPI print and if they were related to a tariff-induced factor. So I think there is going to be a lot of head-scratching, a lot of analysis done on today's print. The worry for the markets is that the tariff-induced inflation shows up sooner rather than later, and we get hints of it in today's print. print. Most economists think that the bulk of this tariff shock might not come until later in the summer. Some economists pointing to July, we could get a 0.5 reading on core CPI month on month. But today, the estimate is for a 0.3%. And if you look at how inflation has been doing, if you look at the last 3 months and annualize it, we're still doing pretty well. It's 1.5% is the 3-month annualized CPI. So decently below the Fed's 2% target. It's just a matter of whether tariffs are going to disrupt this current progress on inflation.
Yeah, which makes me ask, because we just don't have any clarity on the tariff story, either in the short, well, a bit in the short term, but not really beyond July, then beyond August. There are key dates there. These things could drag on, though, as we know. And so you wonder how much the data can matter in that context, the very short-term inflation picture.
Yeah, exactly. Even the recent line that the EU negotiations are expected to go beyond the July 9th tariff deadline does really extend, perhaps for economists, just when this inflation shock would hit the U.S. economy. Currently, the thinking is later in the summer, but definitely that could push into Q4 if these trade discussions, these tariff negotiations don't necessarily come to fruition, and we have to keep waiting for the outcome.
OK, Valerie, thank you very much. Bloomberg's Valerie Teitel with a look ahead to the US CPI print. We're also looking ahead to the UK spending decisions. The UK Chancellor Rachel Reeves is set to reveal her spending plans for the next, 3 years for some of it, but further ahead for some of the other buckets of spending. Reeves will defend her fiscal choices in the face of a weakening labour market and declining political fortunes. Let's speak to Dame Meg Hillier, Treasury Select Committee Chair for the UK's House of Commons. Meg, very nice to have you with us. Thank you for joining us. So your role at the Treasury Select Committee is to kind of hold the Treasury to account. You'll be wanting them to spend money on certain things, the things that make a real difference for the UK economy. So what will you be watching for?
Well, I think we've had a lot of them already announced. Obviously, there's big announcements on capital expenditure. And I think today we know what the total cake is. That was laid out last November, trimmed a little bit, reconfigured a little bit in the spring statement. Now it's how it's carved up. And we've obviously seen extra boosts to the health service and to defence, among others, and other announcements in the last week. So it'll be what we'll be looking for is where the trade-offs are in the departments that haven't had that kind of special treatment, if you like. What's really important, though, for everybody to understand is this was a zero-based review. Each department had to go through every corner of spending and decide what its priorities were and then discuss that with the Treasury. So we may see, and the bit that probably won't be announced today, is certain things that are actually just dropped or reduced or slowed down because they're just not a priority for a new Labour government. And so this will set out really the direction of travel and the values of what a new Labour government wants to achieve over the Parliament and beyond.
OK, and we're not going to be dealing with new estimates about how the UK economy grows today, Meg. That's a different process, as you set out, around the budget and the OBR. But do you have concerns around that? And will you, as the Treasury Select Committee, be chasing that kind of clarity? Because we got Labour data yesterday, which showed a drop in the number of jobs in the country, the biggest in 5 years. Retail and hospitality in focus. A lot of people saying that some of the policies that were brought in the last budget are having this chilling effect on the labour market.
Well, obviously, I mean, the government has set its highest priority as growth. So when the Chief Secretary to the Treasury, Rachel Reeves, number 2, appears in front of the committee in 2 weeks' time, we're obviously going to be asking how this is going to deliver on that growth agenda. So we'll be looking at the public spending envelope. But, I guess what he'll say is the infrastructure spending will boost the economy. We need to be pushing about how clear they are that it will actually be delivered on the trajectory that's promised. So, for example, some of the transport links in Manchester and the North East, if they're delivered on time, that can bring in private investment. And we've seen that when you look at HS2, when that doesn't happen properly on schedule and there's a lot of uncertainty about it, that dampens down or reduces or even nullifies completely that private investment. You need to have that confidence. So we will be pushing on that. And another thing we'll be looking at as well is, it is important that the public purse manages and trims its budget according to what's available, as are the general public when it comes to the cost of living. So when they make promises about efficiency savings, we'll be drilling into that, because often that can be a shorthand for government for, we hope this will happen, but delivering efficiencies in government is the holy grail, but is not always as effective as promised at moments like today.
Investors, good morning, Meg. Thanks for your time. Investors will also be looking ahead, or have one eye on the autumn budget. We've had the IFS coming out, the Institute for Fiscal Studies, suggesting that there will have to be, and I'm quoting, chunky tax increases in that autumn budget. Is that now the likely prospect, given that the Chancellor has committed to those fiscal rules?
Well, I mean, the Chancellor, as you say, is very clear that she's committed to the fiscal rules. And I have to say, it would be unusual for any Chancellor to change them within the first year of government. But Chancellors do change fiscal rules over time. You know, they don't last forever. Fiscal rule is what the Chancellor said it is. But I think she's been pretty clear that she wants to see those, has set those, and wants that as part of her base of stability, her promise to keep things stable and to manage public money. Look, I'm not going to start predicting what taxes she may or may not raise. She has been very clear, and it was in the Labour manifesto, that certain taxes would be untouchable, and that's something that both major parties were saying in the general election. So there is very limited scope. I think that you know, the other option is to discuss whether there are further changes, but this spending envelope that's been set out means that that spending is set. So I'm imagining those discussions with the Treasury were very tough. As we know, some of them went right to the wire. Departments really pushing for their priorities, and it's very difficult if you're the Home Secretary to say what's not important or as important in your department as others. But I think if these spending rules are tight and set out and the spending review works, then she may not need to do as much in the autumn. But look, you know, Chancellors have to juggle taxes, investment, growth. They're looking at all of these things, and she will be, you know, she's obviously going to be hoping that some of the announcements today will lead to more confidence, investment, and boost those employment and growth figures.
Meg, how acute is that debate right now within the party about the need to shore up the welfare and the U-turn that happened, of course, on winter fuel allowances versus those close to the Chancellor who want that fiscal probity?
Well, I think actually there's certainly a general understanding, especially after the Liz Truss mini-budget in 2022, about why fiscal probity matters. If that was ever a reminder, you know, that was a stark reminder of what happens when things get out of control and how fast things can get out of control, and actually the role of the markets in this, that this market sensitivity really matters. That said, you know, this is a new Labour government. A lot of new Labour MPs, as a big majority, coming in, wanting to see the changes that our constituents have been asking for a very long time. We see the poverty, we see the housing issues. So those things will very much matter. So that is the challenge. Chancellors are never usually, you know, making popular decisions because everyone sitting down in front of the Chancellor would have a bidding list for their constituency or their region or their country, and she's got to make sure she manages that. So I think that it's not impossible to do both, but it will be hard choices, and that's what the committee will be examining in the next couple of weeks. You know, what choices are being made, and we need to have honesty about what's not being done as well as what is.
OK, Meg Hillier, appreciate your time. Thank you very much indeed. UK Treasury Select Committee Chair. Don't miss the launch of Bloomberg Tech Europe, by the way, this Friday, 6:30 a.m. London time. That is it for opening trade. This is Bloomberg.